And just to add to that point, there are a number of transaction advisors that can be of value, as Pascal has mentioned, that really will walk that journey with you as a business, as an entrepreneur, as you're trying to raise capital. So, down to the last section for the day. So, we mentioned we've looked at the DCF, which is the forward-looking valuation methodology. We've looked at the market company comparables, which is outward-looking. So, how do we compare to other companies in the market? And now, much simpler, and this is a methodology that can even be done in-house. And I like it because it's simple math. The net asset valuation methodology or the asset approach. And what this approach does is that it really looks at the company determining what's the worth right now. As at the end of your financial year, or even today, if you have some accounts that your management accounts are able to say, as of, what's the date today? 3rd October. This is what my assets are, this is what my liabilities are. What am I really worth? And it's mostly applied to asset-heavy businesses, so the likes of your real estate companies, your manufacturing companies, and in the slight cases, they try and look at it as companies that are facing liquidation, right? But now we're looking at companies that are trying to raise capital, and if you're really asset-heavy, you're trying to say, what am I worth right now? I know in private, at individual level, there's what they call the net worth. So how much net worth do you have? So how much money do you have in the bank? How much are your investments? How much cash? Your T-bills, your bonds, your savings, and then how many loans do you have? Personal loan to George. How much do you owe George because you refused to pay him his money? And all the little things. You haven't paid the Duca, the 20,000, and you take all those. You add your total assets. Look at how much do you have, and then subtract your total liabilities. And then get into your net asset value. So what's in your total assets, right? So it can be categorized into 3 aspects. So your fixed or non-current assets. So these are the things that generate that you purchase and you can hold over many years in time. So that's your buildings, your machinery, your land, and any other long-term tangible assets. We also have intangible assets, especially for the tech companies and the fintechs, that look at your patents, your trademarks, your goodwill. That's when you've reached a level of investment, and then also for some SMEs, but this can be a bit rare at the growth stage. At the growth stage, investment properties. There are actually some businesses that invest in your T-bills, your bonds, and the like, and they're able to hold some of those these are now investment property in terms of fixed assets. So is there something that's generating some rent revenue and the like? Then we get into your current assets. So this is current within that can be exhausted within that 1 year. So your cash and your cash equivalents, your accounts receivables. So are there clients who haven't yet paid you? That you're still expecting, the invoices you've issued, but they're still outstanding. And then any other marketable securities, such as the short-term investments, your T-bills and bonds, as I was mentioning. And then you have your other assets, such as your long-term investments, and then your deferred assets. So those are what we look at from the asset side. Then we subtract, so we add all of that up, and then subtract your total liabilities. So this is everything that you owe, both on the current side, such as your payables, to your suppliers, any short-term debt that you might have, any accrued expenses that you haven't made, that haven't been incurred but you haven't paid, so you owe that supplier, and then your long-term liabilities, such as your debt, any bonds that you hold, and then any deferred tax that you haven't yet made. And, really, once you're able to add the total assets, total liabilities, and subtract those, you're able to say, okay, this is what I am worth at this moment. Most times we like to use it to say that, and it's because it's number one, very quick, but we also like to say that this should be the actual flow, right? So if an investor comes to you and says, I'm going to buy a company, I think you're worth 100 million shillings, but when you do your assets minus your liabilities, you're worth 130 million. You say that, no, actually, I'm worth at least 130 million. Then you're able to start that conversation, very similar to the negotiation, say that when you look at my assets minus my liabilities, this is what I look at, but you haven't yet even considered your growth prospects. And it's very straightforward, and these are things that if we, as Mr. Pascal has mentioned, that if you haven't already conducted your valuation and someone comes at you with a number and you say, no, it's something that you can actually be able to make a quick decision on and say, actually, no, that's not what I'm worth. And then you come to the professionals, the transaction advisors, and say, there's someone interested in buying into my company. We need to do a valuation. How do we come up with something? And they've already come at me with this figure, but I don't think it's true. And then you walk the journey together based on the skills that you have, and you're able to understand and provide that context to them. In terms of strengths, it's very simple and transparent, as I've mentioned. It's straightforward, and all the tangible values can be objectively measured. It's very useful for asset-rich companies, especially those with significant tangible assets. So that's your real estate, your investments, your manufacturing companies is a very good aspect, because manufacturers buy land, warehouses, machinery, and at a certain point they'll need some investment, and someone will see, actually, they've done all that investment and they'll want to come in and just provide some form of investment that could provide working capital, because that could unlock their scale. So it's very easy and straightforward to say, okay, from that asset base, this is what I can look at. In terms of, and it's in the worst case, and we really hope none of the entrepreneurs in the room are facing any of that, it provides liquidation value. So if your back is against the wall and you say, okay, let's close shop. Close this business and start something else, you're able to say, okay, this is the least that I should be able to take, or around the range that I should be able to take. And if someone has come to fully acquire, or you're selling against the bank or some loans, it should be able to help that. Limitations, and these limitations, I'll put a bit of a caveat on some of them, is that the first one is that it ignores the future earning power, but as has been the case for the entire masterclass, we really encourage the use of multiple valuation methodologies. Your net asset will provide you your absolute floor. Your DCF can provide your ceiling. Your market can be anywhere in between or even above. And you're able to say, once I weight all of them based off the different areas, different methodologies that I've used, this is the range. First of all, you can even get a range, seeing from the ceiling to your floor. And then you can also get an average that can be able to advise you that once you're negotiating with any investor, you shouldn't really go too high, you shouldn't really go too low. So as the net asset valuation methodology, it can ignore the future earnings, and this is the case, and this is where tech companies and startups will always say that, but you haven't looked at certain things, you haven't looked at our income. Then please add the net asset value, add the DCF, add your market comparables, and get into a sort of good range. Another challenge or limitation is around your intangibles. We all know that, especially, and I think this is key for tech companies, is that there's something that's very, very seriously contested called IP, intellectual property. And sometimes valuing that intellectual property, and it could be anything from proprietary credit scoring model, from a certain path operation that you do, from a way you make a certain product, across all sectors. And you always have a back and forth with your investors to say that I've worked on this product for 10 years, I've patented it, and I know that this can't be copied, and I'm the only one that can produce a product like this with this sort of information and this sort of quality and with this sort of methodology. So how does that change? So there's usually an issue around that, and it's very important to speak to your lawyers who have very good experience around intellectual property. We have very good financial advisors and consultants that have a very good understanding of intellectual property, and they can be able to advise you on the overall back and forth. The other aspect is around asset values, that they can fluctuate with conditions, right? Today, a plot of land in Kololo can be 2 million. 5 years from now, not even tomorrow, it could be 2.5 million. So it might not clearly define and clearly factor in that market volatility. It will just mostly be based off of the last book value that you have when you audited financials. And it's also very important and also just to add this, is that especially if you have land, if you have buildings, it's important not only for the bank, but to carry out regular valuations by real estate providers to revalue those properties if you require. Because the value of a building in Kololo 5 years ago is very different from the value of a building in Kololo today, especially if you've done some renovations, some additions. It's always good to keep that value up to date, not every month, not every year, but on a consistent basis such that you don't lose touch of that value as well. And that also speaks to the next point on not always reflecting on the true value. And it may underestimate that value, especially on some of those tangible assets. So make sure you also use a bit of combination. So we're all open to working together and identifying what are some of the assets that sit. So if land and buildings are heavy on your book, we know that land doesn't depreciate. So, but we'll need to revalue it and see, okay, what is the value today? How do we change that? And how does that change your overall valuation? If your land consumes or constitutes rather 70% of your asset base, have another look at it. There's a valuer who can be able to provide that for you and then be able to go forward. So I'll briefly take you through what a case study was. So we came up with a manufacturing company, a company that manufactures spare parts for vehicles, so your bicycles, your motorcycles, and cars. And I'll just take you quickly through what the net asset methodology brought us to, and then wrap up from there. And then take out any questions and wrap up. Okay, so in terms of the absolute methodology, so we had the numbers as at end of their financial year. So the financial year was 30th June. And there's two things that we can look at, right? So we could have a book value that's what the audited financial statements say. And then we'd have what we call a fair value. So a fair value would include any other valuation adjustments that, for example, if you revalued the land, if you revalued the building, or revalued an intangible asset, that would be able to show that on the book, it shows that it's the land or the PPE, the plant and machinery is 4.1 billion worth. But when we look in the market, the fair value, once you've made all other adjustments, is actually maybe 5 billion. So we'd be able to say that as at this date, we've revised the figure and then add that valuation adjustment into it. So for this case, we had a total asset base of 8.7 billion, and then a total liabilities of 4 billion, which were mostly your long-term borrowings and your trade and other payables. And the idea is that if someone was to come and wind up your business today, how much would they be able to get at the absolute minimum? So this is briefly around the net asset valuation. It's pretty straightforward. It also helps from an entrepreneur point of view to know your flow. And it gives you a starting point on how to how to interact and speak with the investors, and then also helps you know that there are people like George and David who have done this work for quite some time, and a lot of other transaction advisors that are within our deal flow facility panel of advisors that are able to support you to do the overall valuation and transaction process all through. So that, I think, is the end of the overall valuation masterclass. So I will take a couple of questions if there are any. Yeah. Thank you.
The question says, what methodologies do you use to adjust valuation multiples in a market comparables analysis to account for differences in capital structure, profitability, and operational risk? And they say great presentation.
Yeah, thanks. So as I presented the methodologies on valuation adjustment, why I made this brief, but it's just intuitive understanding of multiples. That when I pay 10x of multiple now as an investor, the implied future return on that investment is 10%. It's a very hard thing to explain, but it's intuitive. That the more I pay, the less likely my investment is going to yield in the long run, and I need to a near extent arrive at a price I pay versus the return I make. When I pay 2 times as an investor, then the room of safety I'm giving for my investment is to return up to 50%. So there are 2 issues here that you're addressing. It's the margin of safety to take risk in the investment that informs your multiple to pay. If you pay more, you're reducing your margin of safety or margin of risk and therefore return. Okay? So you can look at it from a margin of safety perspective, or ability to take risk, or from an implied return. When you pay more, when you pay less, you have a higher margin of safety on the investment and ability to take risk to realize return. I'm not saying you're going to earn 50%, but you're saying implied that I have a bigger margin of safety because I paid less. Now, the methodologies you use depend on a lot of time you've spent around some of these deals and how they panned out based on what you paid and ability to allocate capital to more riskier versus less riskier deals, and how that evolved over a 10-year period, which I know you don't have, but you'll have to get it from somebody who had it. So the methodologies in adjustment are really to take discount factors. You can say, I'm going to discount this by 10%, 20%. It's subjective, and you just have a conversation as to why 20%, why 50%, why 30%. The issues are, what are the business risks in generating money? That's its profitability. What is the business margin or safety to repay its debt and equity shareholders? What is the business model, and is it replicable? Is it in a competitive environment? Is it a monopoly? Monopolies are more efficient than competitive markets in allocating capital, so you're likely to want to invest in near monopoly than a very competitive market. And of course, what is the type of management that is there to execute on the business plan? Now, those elements should be more than less, so that if you can put them in a matrix or you put them in a dashboard, you can then weigh which is more important and then imply the discount or the premium on the multiple. So I know I've not answered your question well. That's why you want to rely on people who have a bit more experience in interpreting the risks of a business versus the opportunities. If you think that you're going to just go on a dashboard and punch in numbers, AI, and I don't know what, I don't know. You might get some results, but it will be winking in the dark.
Okay. Any more questions before we conclude?
Thank you very much. I have a question for David, and I just wanted to know whether you, as an investor, when you give a number, a valuation to a company, you explain how you've arrived there and educate that company on the different methodologies and why you think there should be a premium or a discount and so on. How transparent are you as an investor when you do that?
Yeah, thanks, Christina. I think the more you educate the entrepreneur as a private investor about how you arrived at the valuation, the easier it is to find alignment. For me, I don't mind sharing the methodology and why the methodology is arriving at 20%, not 10%, despite the difference, of course, in convergence between investors and entrepreneurs. But the more you explain what drove that value, the more scientific your outcome is than trying to bulldoze promoters into some sort of methodology that is in the dark arts. So you explain so that you arrive at alignment, because alignment is key as to determine how do we structure this deal. Then, as I said, maybe the valuation came at 20 and you felt 20 was too much to take today, so you structure as 20% on EBITDA. You will take 20% of EBITDA until we get to this stage, then we convert. If we don't, then we find a way to pay you out based on the formula. I make money, you make money. First 3 years, I've executed the project. Now I feel I'm on a growth trajectory, so I need to consider you converting now your 20% into dividend payable rather than EBITDA and. Right? So the more you explain, the easier it is to generate alignment and structure the right type of deal for both the investor risk to make return on the investment and also for the entrepreneur not to enter rooms and start, saying things out of desperation.
Yeah, thank you, David. And Michael, I just have a question. Okay, assume you get the transaction part that you are talking about from someone else who has done a transaction. When you're applying the multiples, are they industry specific? If so, are there specific methodologies that are specific to certain industries? And then how do you come to the discount part and the premium part using the multiples?
As we said, there are several multiples there. There's price sales, price earnings, and price book, right? 3 general multiples. When companies are in a stage where they are generating a steady flow of revenue, because the business model has more or less been defined, the niche is clear, but they are not yet profitable, but would like, say, an investment to be able to unlock certain revenues without overchanging the cost structure so that they could become profitable, you might value them on a price sales basis. And on a price sales basis, without much change in the sales over the last so many years, you might want to consider that you're willing to pay $1 for $1 of sales because it appears stable. Now, those are very subjective conclusions. They are conclusions we just have to make on the gut feeling that for every dollar that I pay for, I will get the same dollar in sales because the business model is stable. Okay? Price earnings, as I said, you want to value earnings on EBITDA rather than EBIT, on net profit, because the others are manipulatable, and depreciation helps you account for the need for the business to maintain assets or generate new assets for growth. So on an earnings level, I would look at EBITDA multiples as more effective in general for businesses that depend on their assets to generate sales. Now for banks, as I said, banks don't need a huge asset base to generate their profit. So the book is the most important thing that the shareholders consider. That's why I would not value a bank too much on sales or way too much on sales rather than on the book value. So I must be able to give a weight that gives the book value at least 50% of the value generated from price book versus price sales or price profit earnings before. Now that comes with experience of understanding bank valuation versus manufacturing valuation versus agribusiness valuation. And you must have kind of worked across different industries to appreciate that, which will take a lot of time for Uganda to find different experts in different industries. But some experts might have at least 3 industry level of experience. Then the discounts are more of a sensitivity analysis, and they are very bright guys now who are using modeling, and they can do a model for the business risk from 0 to 100, and they can run you a model of where that business is likely to lie based on a computer generated, whatever. You can apply that as an objective methodology, and then use some subjective interpretation of that modeling. I've seen guys who run stochastic modeling. The thing models the whole night, right? 24 hours. It models the likelihood of the business to generate money and gives you a valuation. I rely on such guys for just to arrive at something. And then I use that and I interpret the results of that model around my experience. And then I have to give you an answer. But I have to show you what I've been doing so that either we're aligned or not aligned. So there's a bit of AI computing there where you apply all the sensitivities related to that business, whether it's profitability, if it's reliant on profitability, whether it's growth, reliant on growth, then you apply those metrics across the different valuation metrics that you're using, and you run a model for 24 hours, and it gives numbers, depending on if growth is 5, 10, whatever, it gives, by the way, it gives. Then you get an expert to interpret whether those numbers make sense from their experience or they're seeing something completely different than they've ever seen before, and maybe this is an opportunity or a big risk.
Great. Thank you so much for that. One final, and then we close the session.
Thank you. I'm called William Lin again from Easy Agric. I think mine is non-directed to David, but I'm going to pick from what David commented, then I'm going to ask a question to DFF. I think it's very crucial for such conversations and when it comes to valuation to really be done from the industry specific and the type of investor. Clearly, when I just read between the lines, just shows that technology businesses, according to all the presenters, the more valuation methods are geared towards more of asset-heavy businesses or bricks and mortar. Even though the DCF can try to clarify a little bit of technology, but I would have expected asset to go a little bit into it, especially in tangible asset perspective, because as who run technology businesses, that's our biggest asset as compared to land, as compared to trucks, as compared to anything else. So the question which I have is that what can we do to make sure that we have a little bit more technology-specific investors? Also to try to make, because when I just look at the profile of PCP, of all the presenters, I know the type of businesses which they're investing in. And technology businesses are so special that you cannot ignore attraction. You cannot ignore someone having 10,000 users per month, even if when I'm not yet making money of them, because those are foundation rails. We understand that all technology businesses were built from, first of all, acquiring user, then you run a business model. We know WhatsApp was highly valued, even though it had only traction. You can say that, yeah, that's Silicon Valley thinking, but it doesn't eliminate the perspective of technology industry that that's how all of them operate. That if at all I acquire a user, I can sell him a diaper, I can sell that user oil, I can sell him anything. So any kind of business model can ride on that. So the question which I had is that what are you doing to make sure that actually we try to also to get investors who also invest in technology businesses and they really, really understand their valuation to the specific point that you can have a really, really conclusive kind of point of a conclusive point of making a deal. That's the question which I have, because we are over struggling to get a lot of these investors out of Uganda. And what I'm asking myself from the ecosystem perspective, that what are the ecosystem supporting organizations doing to make sure that actually they bring such investors in such events, to make sure that also other growing tech companies also can benefit from such events? That's my question.
Thank you, William. That's an excellent question. And there's a few moving parts there that you've mentioned. So I'll start by the purpose of this session. So this session was an introduction to valuation, and in response to a lot of the questions that we've been receiving from enterprises, specifically those that have been matched with investors already, on how to go to the negotiation table. So this is to arm you with information on how to go and put your best foot forward, because you'll have done your own valuation with your own transaction advisor. And then when you go to the table, you're actually able to negotiate from a point of knowledge. That being said, it's noted that technology enterprises would want a separate session. Is that what I'm hearing? So we are happy to do that as the DFF, because we do have a few tech enterprises similar to yourself, and we're happy to have another session focusing specifically on tech enterprises, because like you rightly mentioned, methodologies for tech enterprises are not necessarily traditional. They don't fall into these specific 3 or 4 buckets that we've discussed. There are new ratios that are actually being developed every day to respond to the needs of tech businesses, because they don't necessarily operate in a traditional sense where you sell a product and receive revenue. A lot of them are very capital intensive at the very beginning, especially around developing their technology, and that needs to be captured, because an enterprise like that may not necessarily have revenue, but they have quite a bit of assets in terms of their intellectual property assets. So that is noted. We will definitely have a separate session for tech businesses specifically.
I think there was also another question around investors, tech investors.
Yes, the tech investors are there, and I'm sure you've been matched with a few. So we do have them in the Deal Flow Facility platform, and we continuously match them with our tech businesses. One additional thing that we are implementing now that we didn't have in the past, and actually this is very relevant for you, William, is that as a DFF now, we will have transaction advisory post-matching. So essentially providing resources to handhold you after being matched with investors to ensure that you can actually get to the point of deal closure. So we will make an announcement around that. We're working on the back end, but this is something that we'll be rolling out in the next few weeks.
Thank you, Nora. And maybe just to add, William, is that also as the DFF team, we're really intentional about our investor engagement. And just even last evening, we were interacting with some investors from somewhere out of Europe, some of whom are actually tech investors. So those are continuing conversations we thank you for the comments, the feedback, and we're continuing to work and improve the DFF experience for entrepreneurs, and more importantly, improve and increase the investment from investors into the Ugandan market. I think at this point, I will invite Nora to give us closing remarks. And before you leave, kindly provide us with feedback. This is where we come up with more knowledge, more sessions, and this is how we, like I said, improve the entrepreneur, the intermediary, and the investor experience. Kindly provide us with your feedback. Tell us what you'd like to see more of. Tell us how we can improve. Tell us if the food wasn't good and the coffee. And let us know how better we can do. But yes, Nora, you're welcome.
Thank you, Bobo. Before we close, any last questions? Please don't leave the room with questions.
Thank you so much. I wanted to find out if you're going to have access to the presentations sent to our emails. And then secondly, they talked about that DFF has like 5 books published so far. So can you have access to them?
Okay, so for the presentation, yes, we will make this available to anyone who wants to have it after this session. For the deal books, these are particularly targeted towards investors who are actually investing. So it's not necessarily general public knowledge. For the purpose that you would not want your information being available to the wide public, and specifically for purposes that are not related to investment. So unfortunately, it's closed to investing participants of the deal flow facility.
Thank you so much.